Global markets are in the red due to mounting inflationary pressures. Investors are becoming more risk-averse as consumer prices continue to rise and the potential effect on corporate profits and household spending in major economies. All eyes are on the Federal Reserve's meeting on Wednesday, waiting for signals from officials on the future of stimulus measures that gave financial markets a boost but may now be eroding the value of the dollar. Paolo Montecillo reports.
Many Americans are still suffering from the economic impact of the pandemic. Now, they're being driven up a wall by rising prices, resulting from supply chain bottlenecks.
I'll be so glad when they come down. You know, due to the COVID, people don't have money. We just starting back to work and stuff like that. This is outrageous with the prices of the gas today.
I got a truck, so the gas prices is really high for me. So some days I have to borrow money to get to work.
For months, monetary authorities assured the public that rapid price hikes were transitory, meaning costs would stabilize quickly. But U.S. inflation rose to 6.8% in November, the highest rate in almost 4 decades. That puts pressure on the Federal Reserve's policymaking board, which meets on Wednesday. Analysts expect a bigger reduction in the lender's bond buying program and a signal on when it'll start hiking interest rates.
We do see signs of a more aggressive policy tightening cycle. I think markets will have little qualms reacting to that, given Fed Chair Powell's abandoning of the use of the word transitory in describing his inflation outlook.
The European Central Bank is also meeting this week to address inflation in the 19-member bloc. Prices are climbing on the continent partly due to the cost of natural gas. A shortage of the commodity is being made worse by Germany's refusal to open up the Nord Stream 2 pipeline from Russia.
Delays are seen as perhaps exacerbating the energy crunch that we're seeing in Europe, and it could possibly persist into next winter as well.
The IMF says, unlike the US, Europe should see inflationary pressures subside in the coming months. But given the size of the American economy and its ties to other large markets, any crisis there will be felt around the world. Paolo Montecillo, TRT World.
For more, let's go to Carsten Brzeski. He's the global head of macro research at the financial giant ING and joins us from Frankfurt. First of all, investors are focused this week on central banks' actions. I mean, we have the Bank of England, the Bank of Japan, the ECB, the Federal Reserves all set to decide on their monetary policy this week. What are your expectations?
Well, we won't get any rate hikes, and that is important to distinguish between somehow reducing the amount that they buy in terms of assets and a real interest rate hike. We won't get this rate hike, but we will see the Bank of England, the Bank of Japan, the Fed, and the ECB slightly reducing the rhythm, the pace of their asset purchase programs.
Right, a question on oil, because demand for oil is set to be lower than expected next year. At the same time, though, the IEA maintains that recovery is already underway and it's not expected to be completely derailed. Where do you stand on this?
Well, I see rather oil prices being stable and maybe even going up, because don't forget, we have so many Western governments which will engage in the big green transition. And the green transition means initially, even though you want to go to renewable energies afterwards, but initially you need fossil fuels in order to fuel all the investments that are needed. So I would be a bit more skeptical to say that the demand will drop. The opposite will be true. We have a global economic recovery, plus many governments investing in the green transition, and this should increase the demand for oil.
Right, and you said no rate hike this week whatsoever. What about next year, first half, second half? What's your expectations as to that? Is there a potential of, the beginning of a rate hike?
There definitely is. I think what we see right now is that all central banks have finally entered the exit lane, the exit from ultra-loose monetary policies. What comes afterwards is clearly a first rate hike. And we will probably have the sequencing that the Bank of England will be first, then followed by the US Fed at around summer, late summer next year. And the European Central Bank will be the third one. And I expect them to start hiking in very early 2023. So rate hikes are not around the corner, but they're clearly on the radar screens already.
Right. We just heard from a news package on inflation. Some economists are actually expecting inflationary pressures to peter out in 2022, especially in Europe. Why is that the case? Why especially in Europe? And also, do you agree?
Well, I do not fully agree. I think the first half of 2022, also in Europe, will still show quite some high inflation. Why is that? Because we have these second round effects that pass through. Producers are facing enormous increases in their material, in their input price costs. So they will pass them on to the consumer. And this is still happening. This will happen in the first half of next year. Afterwards, if we look into the second half of 2022, it is true. We will see that the inflationary pressure will start to come down. This has to do with mathematics, the base effects. The big push from energy prices will slightly peter out. The impact that we had in Germany from a VAT tax reversal will peter out already starting next year. And then also this post-lockdown price markups, they will start to peter out after the summer next year. So which means, yes, inflation will still be high in the first half of next year, but start to come down in the second half.
And one last question. The word of the year when it comes to inflation really was transitory. But I mean, it seems that the Fed is dropping the transitory aspect from inflation. Do you expect the ECB to follow suit?
Not yet. I think the ECB will stick to transitory. They will not push it into retirement home. They will, because transitory can be pretty long. And I think that the ECB will stick to this narrative that inflation will come down. If they wouldn't, that's the whole thing. They have to. If they wouldn't stick to this narrative, they would actually have to talk about rate hikes already. And that is something they don't want to do.
Carsten Brzeski, many thanks for being with us today. Much appreciated.